All right, we've got a good number in the room now, so we'll kick off. Um, Hi everyone, thank you so much for joining us today. I'm Natasha. I'm the CEO of Cable, where we automate the second line of defense. Today, we're going to be discussing the regulatory changes expected in 2025. We're going to go deep into some of the key regulatory changes that could come up and try to leave you with some practical tips about how to prepare for next year as well. We'll also leave some time at the end for any questions. So if you have them, please do drop them in the chat. Before we jump on in, I will let each of our panelists introduce themselves. So Sheetal, why don't you kick us off and then over to Euna and Amy.
Sure. Thanks so much, Tash. Thanks everybody for joining. I'm Sheetal. I'm the General Counsel and Chief Compliance Officer of Treasury Prime. And for people who don't know what Treasury Prime does, we're a bank operating system that really bridges the gap between traditional banking technology and modern finance, providing financial institutions everything they need to build, launch, and scale new business. Thanks for joining.
Thank you so much. Thanks for joining as well. My name is Euna Kim, and I'm the general counsel of a company called Slope. If you haven't heard of Slope, we are a Series A YC company in the FinTech space. We are a B2B lender, and we also have a really cool B2B SaaS product for underwriting.
Hi, everyone. I'm Amy Whitsel. I'm a principal on the Advocacy team at FS Vector, which is a financial services focused consulting firm based in Washington, D.C. Thanks for joining, everyone.
Brilliant. Well, Amy, we're going to kick off with you. Why don't we start by looking back through 2024 and reminding ourselves of the roller coaster that was the past year in the regulatory environment. So can you summarize for us what happened in the last year?
Sure, happy to. In 2025, regulators took a pretty enforcement-heavy approach, particularly to bank relationships with third parties. We saw a lot of concerns about things like liquidity management and misrepresentation of deposit insurance. And regulators also issued several consent orders to partner banks. In 2024, we saw that ramp up in the summer of 2024, especially. And some activity in the private sector also increased the scrutiny that we already saw kind of brewing in the sector. So we saw the Synapse collapse, and this bankruptcy and the earlier failure of Silicon Valley Bank in 2023 underscored some of the weaknesses in the current regulatory framework and heightened concerns about arrangements where non-banks might be functioning like banks, but without having to meet the same regulatory obligations. And this has prompted some recognition from the prudential regulators and members of Congress also that adjustments are probably going to be needed moving forward. The FDIC, for example, has issued two proposed rules. We saw the brokered deposits proposed rule, and then another which would heighten record-keeping requirements. When issuing those rules, the FDIC cited the Synapse failure kind of as rationale for issuance. And then we also saw the interagency request for information and a joint statement from the prudential regulators on bank FinTech arrangements, which continues to demonstrate that regulators are assessing where updates might be needed on third-party risk management. We saw the Federal Reserve establish the Novel Activities Program. And then also on the CFPB front, we've seen some efforts to expand supervisory authority to cover certain types of non-bank entities. We saw the larger participant rule in the consumer payments market, interpretive rules on EWA and BNPL. So you're correct. It has certainly been a roller coaster and a slew of different regulatory activity. And it'll be interesting to see how the Trump administration might take a different approach moving forward.
Yeah, a busy, busy year. No wonder all compliance officers are currently exhausted and looking forward to the Christmas break. Sheetal, what do you think the biggest impact has been of all of this regulatory pressure on banks specifically?
Yeah, and like Amy, I think when I think of 2024, I really think of it in two parts, kind of, the first part, pre-Synapse collapse, and then the post-Synapse collapse. And I think even in the first half of the year, we saw even the banks that were going through exams that had really clean exams and clean, like really no findings, were still under immense pressure from their regulators, particularly FDIC-regulated banks, as it relates to bank FinTech partnerships. And these are banks that were very proactive and engaging with regulators. And so there was somewhat of a chilling effect on the banks feeling pressure to either pause some of these programs or really double down. And then the second half of the year, post Synapse, kind of into the summer, I think that really intensified. And what that really meant was, I think that it didn't necessarily cause or precipitate banks to exit the space, but it really, I think, created higher standards, and banks were really looking at even the quality of fintech partners that they were engaging in. There was much more pressure on the fintech side to provide things like, what are your financials? We don't want to be in a Synapse type situation. What is your security and data security policies? And then for tech providers like Treasury Prime, I think what we saw is a lot of pressure that we're indirectly feeling because the banks are getting it from their regulators on, how do we know you're going to exist? You're a venture-backed startup. What if what happens to Synapse happens to you? So unfortunately, the anomaly became almost representative of the space. So there was definitely pause and reticence for these partnerships.
Yeah. And we certainly did see a couple of banks exit the space. And at Cable, we certainly saw a couple of banks who were about to get into the space, even running RFPs for vendors, pull those and decide to not enter. And I think probably wait to see what happens in early 2025. So difficult for banks to sort of plan ahead and think about how might they increase deposits through 2025 when there's so much uncertainty.
Yeah, for sure. The thing I was going to add too is, I think one of the themes we saw with banks is, if they were looking to do something else, like they were looking to, explore M&A or think about a new product, that really played in a role in figuring out if they want to either continue or enter the bank fintech partnership. So it kind of blended what else are we doing, and this idea of staying under the radar with regulators.
Yeah, very much so. And what about for fintechs? How has 24 really impacted them?
So I can only speak anecdotally. So I have been in the fintech space for a few years and used to work at a very large bank. And I definitely have seen an evolution reaching to the culmination in 2024 of what I feel like is very good oversight by banks. I would say, truthfully, a couple years ago, even being, the lawyer for the fintech, I would have actually hoped for a little bit more regulatory oversight, because as a fintech partner, if your bank is in trouble, that's problematic for you as a fintech partner. So you actually want your bank not to have regulatory scrutiny. You want them to pass all their exams. You want them to understand what's going on, because there's repercussions for you down the line as a fintech. So what I saw in 2024 is, and we just got such a great bank partner at Slope, a very robust legal clients team that really looks at everything, that reaches out regularly. We have like a monthly, quarterly, yearly compliance review. Every product change, it goes through risk committee. So just sort of anecdotally with me as a fintech, I've definitely seen an evolution. Again, I think you're right with the pre and post Synapse ordeal of a lot of diligence in terms of regulatory oversight by the partner bank, which again, I absolutely welcome as a fintech partner, because, if the bank can't ship, we can't ship. And so we definitely want our bank partners to sort of be on top of all this and be like in healthy set with their regulators.
Yeah.
It's such an interesting insight too. Sorry, Tasha, I just want to jump in, because I think like a couple of years ago, we heard kind of this idea of regulatory scrutiny as almost being weaponized and spoken in a very negative term. But it's really interesting, because I do think what we're seeing, the trend is from the perspective of fintechs, the mature fintechs and the really established fintechs that are welcoming regulation and welcoming kind of that partnership with banks on the regulatory compliance front, are kind of suited for the long position, and not necessarily talking about it in the same negative terms. I think that's really interesting.
I mean, just having been, we've all been outside counsel, worked at a big bank. I mean, any sort of regulatory non-compliance, maybe in the short term, something that, I don't know, some fintech can get away with or a bank with, but it always comes to you, right? It always, whether it's 5 years down the line, 7 years down the line, it does. And so it's really important, I think, for the fintechs to really partner with a bank that is not going to take shortcuts, that's going to, cross all their T's, dot all their I's. I truly believe that. And I think that is really if there's going to be a fintech bank partnership, the key to longevity for a fintech is really to partner with a bank that is going to do the right thing and is going to sort of have a great relationship with regulators and be on top of all the bank fintech relationships.
Yeah, definitely true. Okay, so now we're going to get into the meat of the webinar. And anyone listening, we have come up with 3 topics that we want to spend a little bit more time digging into here. If there are other topics that you want us to dig into, please post them in the chat and we'll pick those up too. But the 3 things that we're going to spend a little bit more time on here are, firstly, what might change in terms of the regulatory pressure and the number of consent orders in 2025 based on the new administration. Secondly, what, if anything, will happen to the CFPB after recent high-profile tweets and podcasts about it. And thirdly, in Trump's first term, there was some good support for a FinTech license. And so we're going to spend a little bit of time talking about whether that might come back into play through Trump's second term. So we're going to start off with thinking and talking about what might change with regards to regulatory pressure, the number of consent orders, that intense scrutiny that Sheetal talked about, that banks have been feeling even if they have been given a clean sweep from the regulators. So let's start there, Sheetal, and kick us off. We have seen rumors that some Trump aides have said that banks should push back on regulators, and there'll probably be new leaders at all of the key regulators very shortly. What do you think that will mean?
Yeah, I think it's for sure easier to say than to actually operationalize this idea of pushing back. But I do think change in leadership, particularly at the OCC, FDIC, and the CFPB, seeing what happens there. I think the new leaders will create a different culture, particularly at the FDIC. I think where it's less politicized, less aggressive. I think it remains to be seen what that actually tangibly means for our bank partners, because I think at the supervisory level, the examiners will often probably be the same group of people, or at least some of them will still stay in those roles. And so I think there may be a lag. Obviously, there'll be kind of this pressure of more relaxed regulations and kind of approach to regulatory scrutiny. But what I think remains unclear is what that will actually mean in the next 6 months for banks going through FDIC exams or Fed exams, for example.
I think one of the mistakes to make might be to think that the scrutiny will immediately sort of release and that there will be less consent orders. I heard that actually Trump's previous head of the SEC had given out something like 40 consent orders in her last year. And so actually, we might still see lots of scrutiny, oversight, and consent orders coming through. Yeah. Amy, Euna, anything to add on the consent orders, regulatory pressure that banks and FinTechs might be feeling?
I'll just add quickly that these signals might cause entities to feel sort of emboldened to push back. But I think regulatory relationships are really built on trust and collaboration, and outright resistance to examination and supervision could risk kind of escalating scrutiny. So I think it's important for banks and other industry players to take a constructive approach and engage in dialogue to help regulators highlight specific areas where there could be alleviation of undue burdens, further innovation, because I do think that there is going to be opportunity under this incoming administration for there to be more collaboration with the private sector and healthy dialogue.
I would only add, and I know maybe we'll talk about this later on, this new administration is going to be really interesting for crypto, right? So there are going to be things like staking and lending that maybe crypto companies were a little bit concerned about with the prior SEC commissioner, that maybe they're going to do it now because it's sort of generate high revenues. We've all seen crypto, Bitcoin hit 100K. And so I think we're going to see a lot of interesting things happening in the space.
Yeah. And we've had a good question come in here from Michael. Thank you for submitting it. Do you think that there is the same amount of scrutiny for loan and BIN sponsorship as there is for products that lead to deposit accounts? And will that change with a new administrator?
Euna, do you want to take that one? Or
Yeah. I'm happy. So the same amount of scrutiny for loan BIN sponsorship as there is for product. I feel like there's more scrutiny for consumer lending products because of all of the regulations, right? TILA, ECOA, all of that stuff. I don't think there's going to be the same amount of scrutiny, right? I think with the new CFPB head, there's obviously this new administration is going to care about less regulation, not more. And so I actually think this is, going to be sort of a less concerning time for consumer lending providers. My prediction.
Yeah. Brilliant. Well, thank you for the question, and keep them coming if you have any more. All right. So in summary, we think that actually scrutiny may well continue for the intermediate period, and there may not be a drop in consent orders. A lot of that might be driven by the fact that the examiners that actually come and visit you in the bank day to day, those may well not change. Those will probably be the same people with the same goals there to achieve. And so we'll see how a change in the leadership at these regulators will impact that. So moving on to the CFPB, it's gotten a lot of attention recently. Elon Musk obviously tweeted that it should be deleted, and Mark Andreessen went on the Joe Rogan podcast and talked a lot about it and debanking and PEPs and other things that he knows some things about and some things not so well about. Amy, can you give us a little bit of context here? Like, could we see the CFPB disappear? Like, how easy would that be for the administration to do?
So just to start, the CFPB has faced several challenges since it was first stood up. We saw a challenge to its funding structure in the Supreme Court case, CFPB versus CFSA, earlier this year, and several pieces of legislation have been introduced since the CFPB's formation to kind of diminish the agency's authority. It's a fairly resilient agency based on how it's responded to all of these challenges, continues to stand despite some of this scrutiny. I think to answer the question, you have to start with a determination of who has actual authority to dismantle the CFPB. I think this would require congressional approval. While the CFPB has certainly been a focal point of controversy, I think it's unlikely to be dismantled entirely. The agency has continued to show resilience and plays a pretty central role in consumer protection. And there's also bipartisan consensus on some of the CFPB activity that we're seeing now surrounding consumer financial data protection. And so I just think that makes it difficult to envision its complete disappearance.
I think that's a really interesting point, Tash. Actually, that's worth calling out. I think that we talk about whether regulations are going to be relaxed or not, but one of the key areas as it relates to this space is data security and privacy, and there is a lot of bipartisan support. I mean, you look at 1033, it very much mirrors what Trump's Treasury Secretary was proposing even back in 2018, and so I think it's interesting to keep in mind that even though some regulations may be relaxed, other regulations like data security and privacy and the open banking standards, I don't think those are really going anywhere, regardless of what political administration is in power.
Yeah. And so if we generally think it won't go anywhere, what changes might we see? Might there be some more nuanced changes, changes to some of the proposed legislation that's currently going through the process of becoming put in place? Might we see, we'll almost certainly see a change in leadership. What could some of those changes mean for the CFPB? Maybe you start us off with that one.
Maybe just sort of relaxed in terms of the amount of, I think the current CFPB director has really taken an aggressive position in terms of the CFPB's power to regulate non-covered entities, right? And so maybe we're going to see some pulling back of that. And, in terms of like trying to regulate big tech, right? That is not your traditional financial institution. Maybe we'll see some pulling back of it as well. But it'll be interesting to see. I agree. The CFPB is here to stay. Super, watchdog. I would consider it to be that way. And, I think bipartisan interest in protecting consumers exists regardless of the administration.
So Google might be let off the hook, having recently been pulled under the remit of the CFPB. Yeah.
So just to reiterate, the finalization of 1033, which would allow consumers and third parties to access certain types of financial data, was pretty historic, over a decade in the making. And I think appetite for challenge on the congressional front under the Congressional Review Act is relatively low, even among Republican offices, due to the bipartisan support for consumer access to financial information. We saw the BPI lawsuit challenging the rule, and I think that could present some obstacles to finalization of the rule as is. but this rulemaking was such a long time in the making, and there's just so much support for it. I do think that some version of it will likely survive. Um, and we also saw the data broker rule issued recently. This is just in the proposed rule phase. This rule would characterize fintech companies as some additional fintech companies as consumer reporting agencies under the Fair Credit Reporting Act. And this would impose restrictions on how those companies use financial data under the FCRA. There would be some additional restrictions there. So that's another one where I think the general bipartisan support for consumer financial data protection and also the pushback on big tech could lead to some aspects of this rule surviving as well.
And I think that the underlying point here is, even if there is this sort of high-level Twitter noise about deleting the CFPB, there needs to be a regulator in place to regulate and to ensure compliance with these rules that have been put in place. And these rules, as you say, Amy, have considerable bipartisan support. And so if you're going to have support for those rules, they need to have somebody in place to oversee them. And so we can't simply just get rid of regulatory bodies. Yeah. Hopefully that sets some people's minds at ease. All right, the third topic that we're going to get into here then is whether or not we might see a new fintech license or a payments license or something like that. Particularly interesting after the, as we talked about, the two parts of 2024, obviously after the Synapse collapse. Do we need greater oversight of fintechs? Does there need to be some formalized approach to having oversight of them? So, Euna, why don't you talk to us a little bit about whether you think this might come back onto the legislative agenda, whether something might come to fruition here?
I was thinking back when the FinTech license was first introduced years ago under, the former Trump administration. I was working at a big bank at the time, and there was like a palpable fear within the bank, this federal bank, this big federal bank, because we were worried that as an incumbent, all these FinTechs are kind of taking our customers, chipping away at our product offering. And so there was a lot of frustration and almost like anger about this FinTech license because it felt like it's just unfair. Like, we're highly regulated. We have all sorts of, investigations ongoing all the time. It's just those are the way it is for a large bank. And then, this fun FinTech can come in and doesn't have to deal with having to be regulated by 50 state regulators, which is very difficult, and can just get a stamp of approval and just operate and then take away, right, all the customers of the banks. And, I don't know if folks on this panel work at large banks, but there is definitely a concern that the incumbents, 20 years from now, maybe they won't hear it. So there's always this interest in being innovative, whether it's by acquisition or partnering with FinTech. And so actually I felt, and I can't speak on behalf of all the big banks, but there was this alignment with the state that were very much against, right, this FinTech charter. And so what I think is, notwithstanding this new administration, like the states haven't changed, right? And so we saw the first attempt was challenged by New York DFS, and then they won, and then it was overturned, and then like just everybody sort of let it go. But the states are always going to be concerned about overreach by the federal government. Personally, as someone in fintech, there's pros and cons, right? Having one regulator is also like much easier, right, than having many state regulators. But at the same time, there's also concerns about having, one regulator as well, right? So, because then you have to, maybe you cannot operate, nationally. Whereas if you are a fintech, you can sort of shut off having customers in a particular state, like if that state is too difficult for you. Right. So maybe there's going to be an interest, but I think that the path is going to be the same, is that the states aren't going to like it. They're going to challenge it. And maybe within Trump's 4 years, it's just going to be difficult to pass something like there's always just going to be that healthy tension.
I want to definitely come back to this kind of state versus federal area that you've gotten us into. I think it's really interesting. One of the things that I think about being English and having moved to America just last year, in the UK, there is the EMI license, the Electronic Money Institution license. And it has been really helpful and positive for fintechs and banks in the UK, I believe. It has allowed fintechs to enter the space to become regulated in a lot of the same ways as banks, but not in all, certainly much less overall scrutiny. And for the banks, those fintechs who have an EMI license, they can't lend out those deposits. And so it actually provides those banks with an additional revenue stream. They have to hold those fintech deposits because those fintechs have to hold those deposits one for one in a regulated bank account. And so it has actually opened up opportunities for banks to strengthen relationships with fintechs and actually have a new revenue stream by holding those deposits for them. And I do wonder if something like that could be very beneficial in the US. It would ensure that the fintechs had to take seriously a lot of the regulatory requirements that some of them, frankly, don't. And it would enable the banks to perhaps sort of breathe a little bit, knowing that the fintechs that they are choosing to work with are regulated. But I've not worked at a bank in the US. And so I don't know if those things that I see as sort of potential benefits, bankers would agree are potential benefits. So I'm interested in Sheetal, maybe what you think about that, whether that would be something that the banks think of as a good or a bad thing.
Yeah, and it's kind of the age-old debate, right? And a lot of people would argue, including probably Christine, the CEO of Treasury Prime, that this is already happening in the U.S. So if you look at the Bank Service Company Act, a lot of the big technology core companies like FIS and Jack Henry, they're already regulated. So examiners and regulatory agencies actually have the ability to regulate them. And what that does, to your point of what we've kind of seen happen in the UK, is it does create higher standard, as it almost eases the tension for banks to partner with some of those companies because they are also being regulated. But I also think there's the tension that Euna identified that's very real on the part of banks where, are we comfortable with letting non-banks get away with maybe a lesser standard? And this whole idea of Mike Sue talking about the banking regulatory perimeter and what's fair of who sits inside and outside that perimeter. So I think, unfortunately, there's no the answer to it, but I do think that thinking about regulating fintechs may actually make it easier for some banks to justify to its regulators that it's a healthy partnership. But I think there's not, unfortunately, a magic kind of equation of what that looks like.
Amy, anything to add?
Yeah, I think access to a license really comes with trade-offs. It would mean increased regulatory oversight and compliance requirements, which can be challenging, especially for smaller or early stage fintechs that maybe are just not used to accommodating to those requirements. And so striking the right balance when it comes to licensing is really key.
Very interesting. Well, if anyone has any strong opinions about this, who is listening to this, then please drop them in the chat or the Q&A, and we'd love to hear what you think. So back to a very interesting point that Euna just brought up, federal versus state. We've talked a lot about what might change at the federal level, and the heads of these regulators might change. But what about at the state level? How might this federal focus filter down to the state level? How might it change how banks are thinking about their interaction with their regulators? How might those regulators be thinking about what they have the power to now do? Amy, do you want to talk to us a little bit about that, maybe?
Yeah, I can kick us off. If federal oversight is reduced, we're hearing a lot about deregulation under the Trump administration. I think states may feel compelled to step in and fill what they perceive as gaps. And we've already seen this in a couple areas on the state legislative front, particularly in areas like money transmitter law, privacy law, and also AI legislation, where kind of a patchwork of state laws already exists or is currently forming. So another area to watch here, I think, is interchange legislation following passage of the Illinois law prohibiting payment processors from charging interchange fees on tax. I think we might see several other states introduce similar legislation in 2025. So it'll be interesting to see where states kind of chart the path and lead the way under more of a deregulatory federal agenda. And state approaches to regulation and oversight of financial institutions, I think, will be a really important area to watch, because when the pendulum eventually swings back and the government in the future is under Democratic control again, we could see some of these state regulatory efforts used as a template for new federal initiatives in the areas I mentioned, and then also areas like EWA and even fraud prevention, where we currently kind of lack a comprehensive federal standard.
I think the money transmission example is a really good one, Amy, because I think we saw this happen in somewhat in Trump's first administration, where there was talk about a national money transmitter set of laws that would really replace the state level laws. And I think what we saw out of that was even more activism out of states like California and New York DFS. And so I do think that too much, to Amy's point, too much swinging can almost precipitate more activism at the state level, and that becomes much more difficult. You can't get rid of California DBO, right? So I think it's an interesting trend where you have to really have some sort of harmony and concert between state and federal regulators, and can't necessarily act so much in a silo, in my view, at least.
Yeah. Euna, any additional thoughts, given you mentioned this at the outset?
Yeah, I mean, I think you're right. Like, there's going to be, if the federal government is going to sort of deregulate, I think the state regulators are going to feel a little bit more emboldened, particularly states like New York, California, and all really for the benefit of consumers. For example, like money transmission issues. I mean, gosh, having gone through that process many times myself, of course, sometimes you think about, like, I wish there was a federal money transmitter. But going back to your question, Tosh, about the earlier issue about liquidity, it's very difficult to have a state money transmission license from a capital requirement, because it's capitally very intensive, because a money transmitter has to have more than even a 1-to-1 ratio of funds, right? And so, I do worry about, like, state regulators being a little bit more emboldened and passing legislation that's going to be even more burdensome to the FinTechs. So yeah, I do worry a little bit about the regulations in by the state regulators being a little bit more regulation heavy, and how that will impact downstream FinTech.
Yeah, that's really interesting. Brilliant. Well, let's move on and pick up on another thread that Euna left us earlier, which is, let's talk a little bit about crypto. It feels pretty obvious that it's going to get some more support in the next 4 years than it has had under Biden. So how might Trump and his second term impact the crypto industry? Euna, having spent some time working in areas that touch on crypto, why don't you kick us off here?
Yeah, I mean, we've seen there's a big crypto rally, right? It's been very interesting. If you look at companies like Coinbase and Robinhood, my former employer, the stock price has really gone up. Everybody's very excited in terms of, like, the future of crypto within the next 4 years. We'll have a new SEC commissioner, right? There's just a very different temperature and sort of stance on crypto and innovation around crypto. And I mentioned before, staking and lending; those had always been, I guess, really hot button issues with maybe more established crypto companies. Should we do it? Are we going to get in trouble with the SEC if we do that? But now I think that there's going to be probably less scrutiny, and then you're going to see a lot more innovation, I think, around crypto. Maybe more on-ramp providers. And within the United States, there was a concern, I would say even a couple years ago, about the US regulating crypto so much that it was really going to be only an offshore activity. Whereas other countries were sort of, innovators in crypto, the US seemed to be lagging. And so I think what we're going to see is, like, the folks in the US are going to be very excited about the fact that there can be more innovation with crypto in the United States, and a lot less pushback by the federal government.
Amy, what do you think? Do you think there'll be some more on ramps? Do you think the US will pull any of its regulation that it has introduced in the crypto space?
I think that the main change will probably be the enforcement posture of the SEC under new leadership. Under Gary Gensler, we certainly saw a lot of scrutiny of the crypto industry and characterization of crypto assets as securities. So I think that we'll likely see this approach change. And then also kind of the bank partnership with crypto companies, some of the regulatory actions that space, I think, might eased a little bit. I think that there might be more potential for bank relationships with crypto companies without quite as much pushback under the new administration, but we'll see.
Yeah, there really only is a small number of banks willing to work with the largest crypto companies at the moment. And so perhaps we'll see more of those banks entering into that space and being willing to bank crypto companies. Sheetal, do you think this will impact banking as a service and the relationships between banks and fintechs in any other ways? More crypto, how might that impact banking as a service?
I think it may kind of increase the umbrella of fintechs being able to bank with kind of community regional banks. I think to your point, there's maybe a handful of banks today that are willing to bank crypto companies. And so if you are a fintech that is in crypto or touches crypto, you're very limited with finding bank partners. I think, at Treasury Prime, we hear frequent, almost like monthly or weekly, we get emails like, "Hey, do you have any crypto banks in your network?" And unfortunately, it hasn't been as pervasive because of kind of the chilling effect. So I think it will broaden the scope of banks willing to be in this space. And then I think it'll diversify for those crypto companies. It'll diversify their access to banking institutions, which I think is a good thing. I think the thing that won't change to your earlier question of like, what will this actually look like? I think there will still be a disproportionate amount of pressure on smaller fintech companies, because I think even with relaxed standards and a relaxed regulatory environment, smaller fintech companies are still going to be facing pressure from their bank partners on having to show things like funding and certain foundational compliance things in place. So that I change, but I think the space will open up.
Yeah. Okay.
I want to add on the banking part, just having, anecdotally, having been, having been in the crypto space for a little bit and having worked at FinTechs and working at a large bank. I think Sheila, you brought this up before. I think this is really going to open up banking for crypto companies. There's always a real concern, especially about the really big banks, about banking crypto companies. Big banks, as we all know, are extremely risk averse, right? And one snip of any sort of very high risk type of customer, they'll just sort of get rid of them as a customer because they have so many other customers they can sort of meet their requirements. But JP Morgan, I'm going to call them out. They have banked crypto companies like a Coinbase, like a Robinhood, and they're very innovative in that front. So maybe we'll see other large banks also banking these crypto companies that previously had completely considered crypto companies prohibited. And then we're going to see other community banks. I mean, it's typically been like Crossover Bank and those sorts of banks that would bank the crypto companies. And now maybe we'll see other banks open up and be sort of the bank partner to these other crypto companies. So I definitely have such a great point about the impact of crypto on banking. And I think it's just going to really open things up. And without a bank partner, it's hard to have a crypto company. So I think that's just a great point. We're going to see a lot of opening up of banking in that regard.
Brilliant. Thank you. So those are the main topics that we were going to cover today. Before we try and leave our listeners with some practical tips, why don't we just go around and see if each of you have any other sort of more under the radar risks or changes that might come to fruition in 2025 under a new administration. So anything that we haven't talked about yet that you think might impact banks and fintechs in 2025? Sheetal, why don't we start with you?
I don't know if there's anything that we haven't really discussed, but I think it's this culture of compliance. I don't see it as a switch that you turn on and off based on the administration that's governing at the time. I think that we will see maybe watered down versions of regulations, watered down versions of enforcement and posture of enforcement, to Amy's earlier point. But I think that, this idea we're in a highly regulated space, I don't see that necessarily just being eliminated. I also think this data security and privacy are going to continue to be really on the mind of regulators, even in this new administration, because this is a space where we're dealing with people's data and people's money. And so I think even one data breach or one bad actor could have very tangible impact on end customer funds, which is what we saw in the Synapse situation. So I think there's kind of this foundational base layer that will continue to stay. And then I think that, we'll see a varying degree of kind of enforcement and specificity. But I don't see it as just a switch that's going to be turned off and completely, disregarded.
Hopefully not. Otherwise, whoever comes after Trump will have a lot of clearing up to do.
Okay.
Yeah. How about you?
Well, we talked about 1033 a little bit, but I do think, I mean, it'll be interesting to see, it's not going to be enforced until 2026, from my understanding. But it is the impact of an aggregator becoming a CRA is actually uh, quite concerning, I think, for a lot of aggregators, right? And so I do think, if you are sort of a third party vendor and then you help, right, fintechs, like there are certainly a ton of companies like that, right? Whether it's just sort of helping out a compliance or whatnot, or looking at customer transactions to sort of, aggregate them or that sort of thing. Can you become a CRA now under this? And then what does that mean about consumer consent? And like, how long do you have that consent? And what sort of relationship do you have then with the bank? So I think that's something to consider, like for third party vendors of fintechs, to think about the impact of 1033 on the services you provide. I don't know if there's going to be a lot of change for 1033 under this new administration. I'm not sure of it. And so that's one thing I think a lot about is I don't think people talk a lot about 1033 and the impact on third party service providers, but I do think there is something to consider. And there's going to be, I think, a lot of regulation there and a lot of maybe investigations for third party vendors that may be considered CRAs, but that are not acting as such.
Yeah, really interesting. Thank you. And Amy, finally, what about you? Anything we haven't touched on?
Yeah, I think that there's always a risk that larger banks and larger institutions will kind of have an outsized influence on policy creation under any new administration. And this could lead to rules that favor larger banks and create barriers to entry for smaller players. And what comes to mind for me, again, is the 1033 rule, which actually exempts banks with assets under 850 million. So I think smaller banks not being required to modernize their data sharing practices could potentially entrench larger competitors. So in this deregulation era overall, exemption from regulation and pulling back of regulation, while it may seem to be beneficial on its face, I think could actually have long-term consequences for competition and market health. And I would encourage smaller institutions to kind of go beyond regulatory requirements where possible when it comes to improving consumer experiences.
Yeah, I definitely agree with that. I think that the open banking in the UK has worked very well for the smaller banks as well to be able to get involved and engage and work with and make money from fintechs. And so absolutely, they should get ahead of that if they can. We've had another question come in. This is for Sheetal about Treasury Prime. Can you tell us a little bit about the capital requirements that you have there to work with startup fintechs and why they are where they are?
Yeah, and I mean, I think one of the changes that we recently made is this whole idea we're bank direct. So our relationships with fintechs is really only through the bank. We work directly with the banks, and the banks partner with the fintechs. So those requirements come directly from our bank partners. Treasury Prime is really just helping connect kind of fintech and embedded finance companies with banks, and so a lot of those requirements, actually all of those requirements, are generated and really kind of directed by our bank partners. And we have seen this trend where more and more banks don't have as much of an appetite to work with, early stage or seed stage fintechs. I think the requirement getting to be higher and higher. I mean, before, maybe 5 years ago, we saw, like under $1 million would be enough to get started. And now I don't think there's any bank partner in our network that would be comfortable necessarily banking fintech that has less than $1 million in funding. And so that's an unfortunate just reality of our times and the space. And I think things like the Synapse collapse really impacts all of us, because that just is going to get more and more to be the norm, in my view.
Yeah, that certainly aligns with what we're hearing when we speak to banks and start to learn about the fintechs that they're working with. They are all wanting to work with more established fintechs with more money, more track record, larger compliance team, and so on. Yeah. Thank you for answering that. Any more questions? You have a few more minutes to get them in, so please do. All right, our final topic then. Let's try and leave our listeners with some practical tips, things that they can actually take into the new year and use to help them maneuver through whatever does actually come. So let's go in reverse order and see, if each of you can just leave our listeners with a practical tip for 2025. So Amy, let's start with you.
Sure. I would say from a staffing perspective, it's important to ensure that your team has the right expertise to navigate the changing regulatory environment. We talked a lot about the state level and how things could evolve there. So I think that having people with the right expertise should probably be number one on the list. And I also think it's critical to develop relationships with the policymakers who will be taking on leadership roles in the new administration. Get to know your regulators, your members of Congress. Building strong connections with regulators can really help you stay informed about potential changes, and then also allow you to influence discussions on issues that directly affect your business on the front end. So you can actually create policy and be a part of the conversations instead of just responding after things have already happened that might negatively impact the industry.
Yeah, that's a really good tip. And I hear a lot speaking to banks that they are sort of waiting to go live with a fintech or waiting for something to happen before they hire people. And I would really encourage everyone listening to actually get ahead of that. If you're going into a conversation with a regulator and you're about to, or you have just launched a fintech, you need those people in seat beforehand. Euna, over to you. What's your practical tip for anybody listening?
So I can only talk about my experience, having worked at a fintech, and without a bank partner as a fintech, you're really nothing. And so that relationship is so important. So you have to establish credibility. If they ask you for something, don't push back. Understand where they're coming from. Be preemptive if there's an issue. Let them know so they don't have to find out later. And having a great fintech bank relationship is really going to move your business forward. I also think it's important to diversify as well, right? So not just have one bank partner, but think about maybe having a couple of them, just because you never know what's going to happen, and you don't want your business to be impacted because of any sort of impact on your bank that you have no control over. So always have the greatest relationship with your bank. And without your bank, you're nothing. But then try to diversify as well.
Very good advice. Thank you, Euna. And Sheetal, what about you?
I think for community and regional banks, I think you have a very a really promising window, but the key is going to be moderation. I mean, I think now is the time that you maybe are able to take a bit more risk. You'll be able to innovate responsibly and enter some new channels, but to never let it get so far where you're getting beyond kind of this idea of a moderation and always having like that base foundational level. So I think that there's going to be some promise in the next 4 years, but making sure it never gets beyond what you would be comfortable talking to regulators last year about. So I think that's going to be the theme.
Brilliant. All right. We've had another question come in. So we're done with our topics. If you have any questions, please post them now. We've got one here from Raymond. Thank you for submitting it. What is your expectation regarding the FDIC record-keeping proposal around FBO accounts? Which of you would like to pick this one up?
I mean, I can respond. Having worked at a large publicly traded fintech who had a large publicly traded bank, we did this already. Like, this was not a rule that needed to be passed for us to do this. We absolutely had to do this in order to say that the deposit was FDIC insured. And we did this on a daily basis. And I worked with engineers to do this. And we would provide the report to our bank. So I actually think this is a great thing. And actually, I think a lot of fintech banks already do this. Oh, go ahead.
No, I'm so sorry. I didn't mean to cut you off.
No, I'm done.
I completely agree. And in fact, if you look at the FDIC guidance on pass-through insurance for fiduciary accounts, you already have to do these things in order for pass-through insurance to actually apply. So I completely agree with that these are not new requirements. These already exist. I think they're just being codified in a very public way to really highlight what happened with Synapse. But I completely agree that these are existing requirements.
And just to add, there's been a lot of conversation about which rules might be subject to challenges under the Congressional Review Act. And I think that this is one where there is bipartisan support for it in conversations with congressional offices. It just seems like the consensus is that this is a common sense action following the Synapse collapse. So I think that this proposed rule is probably more resilient than this rule is more resilient than some others. We saw the FDIC brokered deposit rule as well. And I think that one has kind of faced a little bit more pushback than the record keeping rule. So it'll be interesting to see what comes of it. But I do think that the record keeping rule is probably a little bit more viable.
Brilliant. Thank you. Oh, we don't have any more questions in the question inbox. So I'm assuming that we have covered everything. Thank you, Sheetal, Euna, and Amy, so much for providing your expertise and your input here. And thank you for everyone who attended. It was wonderful to see so many of you here. Hopefully this was helpful. I hope you all have a wonderful Christmas and come back raring to go in 2025, and we'll see what happens. Thank you so much.